3 big stocks at 52-week lows. Meta, Proctor and Gamble, Blackrock. We're going to evaluate them now. We're going to look at them through our 8 pillars and then run them through our stock analyzer tool, which will tell us, based on our assumptions about the future, what price we need to pay for them today to get the returns that we want. So let's dig right into it using our software. Let's go to Meta. So Meta has fallen and fallen hard. Look at this. The price is currently 134. The low is 132, and the high for the 52 weeks is 353, but the all-time high is about 380. Keep in mind, I've seen comments before, people saying, Paul, you said at 350 and 380 it was a buy. I never, ever, ever said that. 100% did not say that. I personally started buying Meta in the mid 200s, but I never, ever, ever said above 300. So anybody who says that is inaccurate.
Just stand there in your wrongness and be wrong and get used to it.
Now, let's look at Meta's 8 pillars. Oh, look at that. All 8 check marks. Now remember, there's 8 check marks here. That does not mean you go buy the company just because there's 8 check marks. You have to sit there and understand the company from a long-term perspective. Now, what are the pros for Meta? 3.5 billion people out of the 7.5 billion people in this world, or maybe it's 8 billion now, use some sort of Meta platform, whether it's Facebook, Instagram, WhatsApp, all their portfolio. So what does that mean? Well, growth is going to be harder. That's the big reason for the big fall. The growth is much, much slower, which is understandable. Now, does that mean just because the user growth is low that it's a bad company? Well, this is my thesis on Meta. They have not maximized the per user revenue. And as time goes on and the world becomes more and more social media and the world becomes more developed, I think that this is the next kind of platform, in my personal opinion, that's like Microsoft and Apple of the past years. Sitting there, and Facebook is trying to become this metaverse and Oculus kind of world and environment. And I personally believe that it's potential that it's a good risk-reward scenario here. But that does not mean you should go buy it just because I believe in it. Go do your own research. So the things I like here: low PE and price of free cash flow. They're buying back a few shares. Guys, look at this. Such little debt. Their long-term liabilities divided by their 5-year free cash flow is 0.9. That means they can pay off all their long-term liabilities with just 10 months of their free cash flow of their business. That's incredible. You have revenue growth, you have net income growth, and you have free cash flow growth all across the board. Another thing, look at this return on invested capital.
Love it.
16.7%. It's huge. Charlie Munger loves return on invested capital. His thought process is, even if you have to overpay a little bit for a company, this is about the return you'll get if you buy the company. Now, I haven't tested that. Obviously, it doesn't mean go pay any price. If that's the case, just sort every company by return on invested cash flow and buy the highest one. I don't think it works that way. If you're still overpaying, it doesn't matter how much they reinvest. Now, here's the interesting part. Meta was a $1 trillion company. Now it's $364 billion. It is down a lot. Let's go see what analysts think.
I'm actually quite shocked by the analyst expectations.
In the terms of, in
good way, in terms of the punishment that the stock has taken. And I'm like, oh, wow, they're even seeing 12.5% in 5 years.
So remember, analysts have a bias, right? Mo, we've talked about this before. Yep. I don't ever pay attention to buy-sell ratings by analysts, but they're very intimately involved. Our data feed gives us these analysts for the next 5 years. Guys, the company is estimated to make $10 per share in profit this year. And guess what? They're estimating $17. It's a 70% increase over the next 5 years. When it comes to revenue, this is what I meant before, guys. They're expecting $120 billion in revenue this year, and they're expecting 188 in 5 years. That's a 55% increase over the next 5 years for a company that's getting very little growth in terms of users. That is my point. The story is not matching up with the results of the stock. Right. So again, these are analysts and they have their opinions, but a lot of these analysts are very intimately involved with the company. And I use these analyst estimates as kind of my high level, my highest point in our stock analyzer tool. So let's go to the stock analyzer tool and see what we're willing to pay for the stock. Now remember, the stock analyzer tool is only as good as the assumptions you put in it. And I'm looking at this and I'm going to put in my 10 years of analysis. I can do 1 to 20. Now, on the high side, analyst estimates for the next 5 years was growth in the low teens, low to mid teens. Okay. So I'm going to put on the high side here, 10%, middle 7%, low side 4% revenue growth. Okay. Now keep in mind, in the last 10 years, they did 40% a year. Okay, so I'm really cutting this down. But as the company gets bigger and bigger, it's harder to get higher revenue growth, right, Mo?
Yep, absolutely.
Mo, what would you put in for profit margin over the next 10 years?
I think I would go 31, 32, 33. I mean, as they continue to develop software, more advertising, I think that profit margin can get increased.
True, but they're also spending a lot of money in that metaverse, about $10 billion a year. So I'm actually going to be more conservative on that. What was that?
What's your high side going to be?
I'm going to do 26.
Oh, wow. Okay.
29 and 32.
Okay.
And the reason being is I do think this profit margin is going to get hit on the low side. So I want to be conservative there. And especially with a company like Meta. The reason I'm doing that is there are concerns about its future. So in order to gain more traction, I feel like if they have to go cut margin by decreasing revenue, things, I think they're fine with that.
Okay.
Free cash flow, I'm going to do the exact same thing because for a company like this, it tends to be consistent over long periods of time. Now, PE. The current PE and price of free cash flow is 10 and 10. I just think that's low. I'm going, well, what are you going?
13, 15, 17?
I agree with that. Because I think if they hit their high numbers, they're going to be a very, very high moat business that can justify a higher multiple with such a high return on invested capital. So I'm perfectly okay with a 17 PE at the end. Now, finally, my desired return. There's a lot of unknowns about Meta. It could be perceived as having a higher risk potential. And as you go higher, in terms of your assumptions, you want a higher desired return to give you a bigger margin of safety. So the market's going to do 9 or 10% over long periods of time. So I want a desired return higher than that in order to justify buying an individual stock with a margin of safety. Mo?
So low side, I'll go 12.5.
I agree.
I think those are
middle.
15.
Yep.
And 17.5.
I agree with that. So guys, the stock's currently 135. I'm going to hit the analyze button. Boom. I got all green. Now, does this mean go out and buy? No. It means go out and make sure that these assumptions are correct. Join our community, everythingmoney.com. Check it out. Have conversations with people. Go do your own research to determine if this is correct. Now, here's what I will say. What this means is that if they hit their high price, their high expectations, you can justify paying $223 a share for it today, and you'll still get a 17.5% return if things work out the way you assume up here. You're paying $135 today if these are all correct. You're going to make over 20% return on your money. All right, Proctor and Gamble. Mo, take it away.
So Proctor and Gamble is a massive company. You probably have so much stuff in your home that you don't even know is Proctor and Gamble. But right now, looking at it, I see why our community likes it. 5-year PE is a little bit high still, but that price to free cash flow that 5-year price to free cash flow has fallen into range. They do pay a dividend. Paul, what do you think about that? A little bit much. $8.75 billion out of 13.
So that's a great question. Usually what we want is we want the dividend to be less than 50% of the 5-year free cash flow. However, my thoughts on Procter & Gamble is where's the growth coming from Procter & Gamble?
It's a $300 billion company, and I don't really see a lot of growth going forward.
Yeah, I mean, they're consumer staples. So I look at it going, how do they get a return to investors? They can buy back shares. They can pay a dividend. I still look at that going, there's only two ways, and it's a nice 2.9%.
Yeah.
You know, a while ago, the market was only at 1.2%. So this is over double what it was before.
And for being consumer staple, look at that ROIC.
I know. That's a huge
16% for consumer staple.
Huge ROIC.
Massive.
The question is, can they keep reinvesting back in the business to get that return?
Right. So let's see what the analysts say. I am going to think that they're going to say it's super okay. I was actually expecting going negative down here in 2027, but there's not. They're looking at 4.27% growth in 2027. Earnings per share in 2027, $8.19. So they're actually seeing growth out of this company. Let's go in and do Stock Analyzer and see what we come up with here. So, Paul, I'm going to go to you. Let's go 10 years out. I think this is a good company that you would put in for 10 years and hold. You're going to get a nice dividend. You're going to get, clearly, their ROIC is incredible. Management knows what they're doing. What do you think on the high side?
So one thing I noticed on the cash flow statement, they have a lot. Every 3 or 4 years, they make a big acquisition.
I was just about to go there.
You know, so it's kind of like, okay, they're driving a little bit of revenue. It's not a huge. I mean, $1 billion, $4 billion. I mean, they're averaging probably
$20 billion or something.
Yeah, and for a $300 billion company, it's not huge.
Yeah.
So I would sit there for low, middle, and high. I would go, 2, 4, 6. Okay. I think 6 is really, really high, though.
I think 6.
So maybe 2, 3.5, and 5. What do you think?
I was almost going to go 0.
Okay, I think you should do it.
Yeah.
So what Mo's doing there, guys, is he's sitting there, and you might sit there and say, man, that's such a crazy number. Our job is to be conservative. Can I see a world in which Procter and Gamble does zero growth in the next 10 years? Yeah, I don't think it's as unlikely as people think.
Mm-hmm.
So be conservative on your low side.
Profit margin.
Profit margin. I mean, it's very consistent.
Over the past 5 and 10 years, it's the exact same number.
Yeah, so maybe 15 and a half, 16.
Yeah, I like that.
I mean, it's such a narrow range. I'd be fine if you just put the exact same number for all three.
Yeah. Oh, just say 15, 15.
Yeah, but I think just 15 and a half, 16 is fine.
PE now. This one's going to be kind of low, I think. I think we're starting at 12. There's no moat.
Well, there's a lot of moat, I think. You don't think there's a moat?
I mean, they kind of do. Let's see what they do here.
I mean, they have so many brands. By the way, it's an Ohio company based in Cincinnati.
Okay, so I'm looking here. Tide detergent, Charmin, Pantene shampoo, Pampers. So people are probably brand loyal, but to the same point.
I mean, Mo, look at these.
I mean, it's incredible.
You know these. I mean, you know all of these brands. These are in everybody's home. I mean, every single day, how many of these? Oh, I didn't know. Oh, perfumes, Lacoste. Okay.
So if we're going to say
Tampax, isn't Tampax your preferred tampon, Mo?
Yes.
Okay, got it. I do that purely for Tim, who's now slamming the table because of how. Okay, so I look at this going, I don't know. I see a lot of brand, people.
Okay, what's your PE? Since we know every brand up there.
So if the historical average is 15 to 16, I would say 13, 14 and a half, and 16.
Okay.
That's my opinion.
Okay. Same
with price of free cash flow.
All right.
Now, it's a lot lower than what they're currently at. They're currently at 20 for each. But guys, we've been in an overinflated market. It's been tough out there. Like, I just think people are overpaying, and historical average for PE is 15 to 16. So keep that in mind going forward.
Desired annual return.
I mean,
I think 12 and a half. I mean, I almost think you can go 12 and a half all across.
Okay.
What do you think?
Well, I still think you should increase. I think the 5% is very high.
Okay.
That you're doing.
You're going to go 12 and a half, 15.
I think 12 and a half, 14, 15 and a half.
Okay.
Because I don't think you need as big a, even if you did 12, 13, 14, I think that's fine.
Okay.
All right.
Current price, $123.50. Got to wait. I mean, with the PE and the price of free cash flow being where they are, you do have to wait $45.48 to a high of $62.61. Guys,
it's just math.
Yep.
At this point, it's just math. If you buy the company, you get certain cash flow, certain multiple. What's your now I think with such a high ROIC, you can probably justify paying a little bit more for the company. Mm-hmm. But like for me, I'm probably adding this to my watch list at around
75.
Yeah, exactly. Just $75.
Start taking a look.
Yep. As a way to start taking a look, not necessarily buying from there, but take a look and see where it stands at that point.
Yep.
Final company.
Lots of people talking about BlackRock.
BlackRock, guys, this is the world's largest money. I mean, it's a huge money manager. They manage trillions of dollars. So let's pull up BlackRock.
$8.5 trillion.
$8.5 trillion in assets under management. Now, 51% of the managed assets in equity strategies, 29% in fixed income. Guys, if you believe what I believe about the stock market, that the three most reliable metrics of the past, 10-year cyclically adjusted PE ratio, price to sales, and the stock market GDP, I believe stocks are not looking good for the next 10 years. This is directly going to affect BlackRock. It's not going to have the same growth that it had in the last 10 years in terms of its growth level for income. Look at this. They've over doubled their revenue in the last 10 years. I don't think that's the same case going forward. And as you get larger and larger, it's harder to grow your assets. But with the headwinds of the market, this is definitely going to be an issue. Now, the stock's currently at 552, and the 52-week high was 973.
Good Lord.
Good Lord is right. Let's see the all-time high. That might be the all-time high. I think it is. It is. That was the all-time high was 973. That's incredible.
Wow.
Okay. So let's look at the 8 pillars. All right. Ooh.
Interesting.
It must be some debt that they have on some of their assets because that's a really high price of free cash flow. So first thing is, I'm going to keep that there, but I'm going to know if I want to go look at this company further, I need to understand this debt level. Why do they have 25 times their 5-year average free cash flow? Pay a big dividend, 3.3%. Eats up, oh my God, Mo, did you see this?
So much. Wow.
It eats up 80% of their free cash flow. Wow. I don't like that. Mm-mm. And their PE is a lot lower than their free cash flow multiple.
I don't like that discrepancy.
Yeah, neither do I. Okay, so far we have a couple red flags for us. Very low return on invested capital. What is going
Now,
on?
why would it be a low return on invested capital?
Let's see. Was there an aberration in the cash flow statement somewhere?
Because
No, it was pretty consistent and growing.
I mean, it had its jump, but nothing crazy.
They don't make acquisitions.
Nope.
Let's see what analysts are saying. I mean, steady growth, double-digit growth in terms of earnings, and high single-digit in terms of revenue. I'm going to be a lot more conservative on that because I think the analysts might have a bias towards this market.
Yeah, financial.
Yeah.
advising.
So right now, guys, I'm looking at this going, I'm not liking some things here, but I'm still going to run it in my stock analyzer tool to sit there and see what I think about it. So 10-year analysis, I'm going to go 2, 3.5, and 5% revenue growth.
I like that more than 246.
Okay. Profit margin. I'm going to do 28 because if the market falls, their margin, they have a fixed overhead cost. I'm going to do 27, 29, and 31. Free cash flow is a lot lower. So understand why their free cash flow and net and profit margin are so much different. I'm going to go 20, 21.5, and 23. PE. I'm going to go with 12, 14, and 16 for the next 10 years. And then desired annual return, 12, 14, and 16%. Analyze button. Stock's currently at 555. Okay, it's not as far off. We have a low of 275 to 375, so call it 350, and a high of 450. So it's not as far off. I would sit there. I'm actually going to sit there and add it to my watch list at 450. So that way, the software notifies me at that point to start taking a deeper look into it. But I don't like the fact that this debt level is so high and they pay out such a big percentage of their free cash flow and dividends.
Yeah, and I don't like their ROIC.
So you're sitting here and watching us and how fast we did this. You got to watch our next video where we talk about emotions, mindset, and process being the absolute 3 keys to investing. And I think that'll help you understand what we did here in our process. Thank you very much for your time. There are 3 things that you absolutely need in order to be a successful investor: the proper mindset, the proper emotion, and the proper process. Which ones are the most important?